IPO Mania is upon us with Lyft and Zoom and Pinterest, and then the lineup coming behind them to include mega deals like Uber. Well, when you look at it all combined, 2019 is shaping up to be the second largest year for IPO launches in the last 20 years. And the reason this is important is that the launching of IPOs is a great gauge for measuring investor enthusiasm and sentiment, and I think a strong indicator for irrational exuberance. The year that the dot-com bubble blew up was the mother of all IPO launches, and then over succeeding recessions, we saw the number of IPOs plunge down to a low in the Great Recession of 2008, and so we find ourselves in 2019 with the number of IPOs estimated for this year to be only second since 2014 in the post-dot-com bubble era. Now, how does that relate to the overall stock market? Well, if you transpose the S&P 500 on top of this chart, you'll see that there's not a direct correlation, but it is a directional indicator. And it makes sense. Whenever money is easy and investors are discounting risk, they're willing to rush into IPOs. And so in years when the market's not doing well, private companies hold off in launching their IPOs until the market is ready to absorb those new shares when investor sentiment is running high. So IPO launches don't always peak when the market does, but I do think it's certainly a directional indicator. Now, as far as my thoughts on IPOs, the remainder of this episode is going to be an excerpt from a recent audio podcast that I did where I described the 3 reasons why I never invest in IPOs. So here it goes. Please listen to an outtake of the Wealthsteading Podcast, episode 286. Reason number 1, and this is the title of the episode, Lipstick on a Pig. In fact, I think LPOs should be called LSOAP. That's for lipstick on a pig. That's an old saying that my grandfather used to say to describe something that was being dressed up and made to look better than it was. You know, hey, don't buy that old car. That's like putting lipstick on a pig. Well, in a lot of cases, that's what I think IPOs are, and here's the case I'm going to make for that. An initial public offering is much different than all the other stocks that are being traded on the secondary market. And what that means is when it's on the secondary market, you're not necessarily buying it directly from the company, and in 9 times out of 10, you're not buying it from the issuing company. You're buying it just from another individual. It's like if you go out and you buy a used car or a used house, you're not buying it from the original car manufacturer or from the original home builder. You're buying it from somebody that's already bought it. It's a subtle difference, but it's a big difference, and the reason this makes an important difference on an IPO is that on the initial public offering, the company is absolutely 100% receiving the money directly from people that are buying this stock for the first time. And when I say the company, I mean the founders and the original owners of that company. The reason that's important and what it has to do with putting lipstick on a pig is that by and large, companies don't have a whole lot of incentive to talk up their stock price when it's just being sold on the secondary market. Because over time, it's the value that sets the price of that stock. Oh, CEOs do come out and try and make things look good quarter to quarter and all that, but ultimately, they're putting less lipstick on the pig because they're not totally directly benefiting from the rise or the decline of that stock. But that's totally different on an initial public offering, because on an IPO, that allows the company or its owners or its original founders to start cashing out. And so they want that company to look as best as it's ever going to look. It's like the first impression you want to make on a blind date. And so the company itself is going to do everything they can to make that company look good. Now, I'm not saying they're going to cook the books or anything. That would be illegal. And we know that people would certainly not engage in fraudulent practices like that. But what I am saying is they are going to do whatever they can to finesse that balance sheet. And then they're going to go out and they're going to engage a Wall Street company or an investment banking firm or somebody to promote their stock. This is someone that's going to directly benefit from the sale of that stock. And they are masters at manipulating balance sheets and putting lipstick on a pig, right? Because that's why they work on Wall Street and they have these multi-million-dollar compensation packages, because they're that good. And then they're also going to go out to their buddies in the media And either directly or indirectly, they're going to get the media and talking heads and celebrities to talk that stock up and talk about how pretty that pig looks with all the lipstick on it. So when you start factoring all those things in to what's being built into the price of that stock, what chance do you have as an individual retail investor to know whether or not you're making a good investment choice or you're just buying a big old fat sow that's got some lipstick on it? Even if these things aren't done intentionally, and again, I'm sure that the wonderful people on Wall Street would never pump and dump anything. But if it's just from a subconscious nature, don't you think their own bias, because they're going to make more money off the sale, is going to at least nudge it a little bit in the direction of putting lipstick on the pig? I think so. That's reason number one. Reason number two, when the IPO comes out, once all the insiders, and I don't necessarily mean insiders like founders and people that work for the company, but all the, inside smart money, the big guns on Wall Street that have the money, that put the financing into these things, that get the sweetheart deals, those are going to be the people that really get in on the initial offering. It's not going to be people like me and you. We're not going to get in on the real sweetheart deal. That's reserved for the muckety-mucks. And so when you do click your mouse button to buy that IPO on that first day or the second day or 3 weeks into it, whatever time frame you're trying to get into that IPO on, who are you competing against? Well, number one, you're competing against all the momentum algorithms, which are trading at a fraction of a second quicker than you are. And number two, you're competing against all the other dimwit individual investors that don't know that they're buying a stock that has lipstick on a pig. You're not competing against the best minds on Wall Street at that point because they've already got in early. You're in there trading with all the retail momentum guys that think because they watch Mad Money with Jim Cramer that they're some kind of Wall Street wizard. And they're buying that stock not based on any fundamental knowledge, but they're buying it strictly on emotion or in the fact that they've heard it hyped up in the media and they think that it's going to go up because they can sell it to some bigger idiot than they are. But you have to remember, it's kind of like socialism. At some point, you run out of other people's money. And when you're dealing with a bunch of amateurs, that money burns out quick. So there it is, number two. You don't want to be competing with amateurs in a market where the momentum is rising and the price is going up simply on emotion. Now the third reason is very much related to the second reason. You see, in the second reason, when you were competing with amateurs, these were people that were like teenagers spending their dad's money, or people that were at their first rodeo. They have no concept of value, and so they're just going to spend, and drive the price up. Now, the third reason is related to that, but it has to do with the psychology of auction trading. In a lot of ways, an IPO is just like an auction. And you can make the argument that any day on Wall Street is like participating in an auction, because that's really what it is. But remember, there are different types of auctions. There are auctions that professionals attend, where they don't outbid each other simply because they're caught up in the emotion of the moment, but they know the value of a particular product, and they're probably going to turn around and buy it and flip it anyways. And so they have limits on how much they're willing to pay. That's a type of auction that's being driven by a profit motive rather than an emotional motive. But when an IPO comes out, it's like a feeding frenzy. All that lipstick on a pig, all the excitement, all the talk, not only within the media, but around the water cooler at work. All the cool kids going to get in on the hot deal. And they're all going to brag to you about how much money they made on the previous IPO. And that's why an IPO is much more like an auction or a circus performance than a normal day on Wall Street. And so not only are you in there competing as the price is getting talked up and bid up by teenagers with their dad's credit card and no concept of value, and also people the first time at the rodeo, they got no idea what's going on, they got a big hat and no cattle. And then to top it all off, they're hearing that auctioneer calling out, I got 50. How about 52? There's 52, 53, $60. Right? They're getting caught up in the emotion of it, and they end up bidding far beyond not only the intrinsic value, but even the hyped up lipstick on a pig value. Think of it like beer goggles. So there you have it. The 3 reasons I almost never, or have never at this point, invested in an IPO within at least the first 6 months of it being offered. I don't jump in at least the first 6 months. I sit out until the hype has gone away, until most people have forgotten about it, until several earnings reports have come out and we see increasing sales and increasing profitability. And if you think I'm being too conservative or way off the mark, well, I could be. But go out and look at a wide variety of initial public offerings, not just something that happened in the last month or two. Go out and look at 50 IPOs over the last couple years. And what do you generally see? You generally see after 6 months or maybe 18 or 20 months into it, the price consolidates and stabilizes well below where it initially came out at, or even the average price over the first 3 to 6 months. Some of this has to do with the way that insiders are restricted with the lockup period of when they can go out and sell their shares. But that's not always the case, because even if you look at stocks that have recently come out that don't have a lockup period associated with them, they still follow that consolidation in the 6 to 24 month period, which I think more than anything has to do with reality setting in and the lipstick coming off the pig. Well, hey, there you have it. That's my thoughts on IPOs. Until the next episode, this is John Pugliano wishing you the very best returns. $50 bid and now 55. Will you give me 55 to make it a 55? I bet a $50 sold that home for a $50 bill.